yeah, today we're gonna look at just a couple of different ways in which we measure risk, or rather, right? There's sort of the buying power reduction, which is sort of how the brokerages and regulators measure the risk of your positions, and then there's conditional evaluate risk, which is perhaps a more reasonable thing for you personally to use to measure your own risk. And we're going to sort of compare how different trades stack up according to them.
Perfect.
And see like why we care.
Okay. So this is kind of buying power versus CVR head to head, right? Which is
conditional value of risk. That's correct.
Yeah. So right. First, we're just going to define them both. Easy peasy. We're going to point out that risk is a complicated topic. You say like, you can pretty often say this is more risky than that, but not in a way that's like fully transitive or summable or like all the things you would want to just say this is this much risky and put a number on it. You have to.
Risk is relative, right? So my risk might be different than Tony's risk.
Your risk, your relationship to risk is different from Tony's risk. Also, just like even in one trade, right? To like give a sort of a dummy example, if you have a die, if you're like just you're rolling a die and you're getting money based on how much the die pays off, there's a difference in risk between one that loses $100 when you roll a 1, but makes $16 or $20 when you get a 2 through 6, versus one that loses $75 on a 1 or a 2. And then makes, I didn't do the arithmetic beforehand, 150 on the 3 through 6, right? Because in one, you're more likely to lose, but in the other, when you do lose, it's bigger.
Yeah.
Right. And so there's sort of different concepts of what the risk is there. But for the purposes,
so good. I got it, Tony. So far, I got it.
Yeah. So
you're doing amazing. You've actually added more in the year that we've had this segment on than I have. So please continue.
Right. So we're just going to do two. There's in fact you can come up with a whole host of different ways we might measure risk. Initially, when I started working on this segment, I was also going to throw theta in here. Total theta, I think, is a nice holistic way to view your risk. It's sort of what the market says, how much you should say every day when things don't go against you. But so you have buying power reduction, which is comes from the broker, primarily goes by according to the regulator, set amounts. It's it's intended to keep your account from taking losses that won't be covered, right? It's a cover their butt. And it's a pretty crude computation, the way that it works. It doesn't account for volatility. It doesn't account for duration. It just looks at the trade and asks, is it defined risk or undefined risk? And if it's defined risk, it says, okay, what's the max loss? That's it. Perfect, we're done. If it's undefined risk, it goes, okay, well, we have to make something up. And then it does sort of a regulator type thing where it's got 3 categories and it looks at which one's the largest. And the 3 categories are, did the strike get broken by 10% of its value? Did the stock move by 20% of its value? And then there's like a dummy term that prevents things from getting like negative or too low. And it is what it is. We have to live with it. We all have, if you have your trading account, you have to deal with your buying power. You have to manage it. You have to use it effectively. Conditional evaluate risk, on the other hand, is more what do positions like this position actually lose when they are big losers, right? It's the average loss from amongst the worst 5% of outcomes. And Julie and I recently had a back and forth about if you took it was like super high pop trades, do you include the mediocre winners in those bottom 5%, right? If you have a 98% pop trade, do you have can your CVAR start including winners? And what
did you guys come up with? That's an interesting question.
No, it doesn't. Right? If you have it's sort of if it's a trade that's better, that's more than 95% probability of profit, then this conditional value risk is just the average amongst the losers. Mm-hmm. Right? Whatever many of them there are, because otherwise it sort of can be misrepresented. Right? It makes those way out of the money things look like sure things or safer bets than they are.
Yeah,
makes sense.
But we're going to look at sort of how these metrics stack up for different kinds of trades, and then sort of think about why we as traders would care about the two of them separately, and then sort of why we might choose a trade that has more of one and less of the other. We'll see into that. But let's get some data.
So far, exciting stuff.
Perfect. So we're just going to do SPY today, and we're going to do 15 years of data on it, and then what we're going to do is we're going to consider everything's sold at 45 days to expiration and then managed at 21 days. And then we're going to compute, right? So the buying power doesn't change on management or duration or anything like that. It's just based off of the strikes and the credits. and the spot price. But the conditional value at risk does depend on how things turned out. So that one, we'll be looking at the 21-day conditional value at risk. And then in order to sort of put these things on apples to apples and also scale them so that we're not worried, because 15 years of data, the SPY has grown remarkably. So just like the numbers are bigger now than they were 15 years ago. And so to sort of put everything in an apples to apples kind of way, we're going to look at everything as sort of multiples of the initial credit. And just for Tony's sake, so that these multiples can be interpreted, if you're collecting a third of the width of the strikes on an iron condor, that means the BPR is twice the credit, right? Because you have a third of the width of strikes, your buying power reduction is going to be the remaining difference from the strikes less the credit, so it's going to be twice as big as the third, so it's going to be a multiple of 2. So if you see 2 on the BPR credit slide, that's exactly where a third of the width of the strikes is.
Perfect.
And so more than that means you're taking on more buying power reduction and less credit, and less than that means you're taking on more credit and less buying power reduction.
Gotcha.
Great. Let's look at the numbers. So here we are. These are BPRs for sort of a collection of trades. So the top row is all strangles, and the lower rows are iron condors. The blank ones are because we're doing all short deltas, right? Our long deltas are always going to be less than our short deltas, to keep these things in sort of the kind of trades that we like to do around here. And what you see is that, like, right, if you wanted to trade, whatever, firstly, you need more BPR to trade strangles, right? That as far as how much credit you're getting out of them, iron condors are generally more efficient, especially sort of wider iron condors, right? The 2010 iron condor is pretty bad. The selling 20s and buying 10s. But other than that, you get a lot more sort of BPR efficiency out of your iron condors, at least in terms of how much credit you're taking in.
And that's standard. Once you're defining a risk, you're capping what you have to put up by so much that's a glaringly obvious example. Yes. Although, right, there are sort of bad cases, right? Like you see that the 2010, because the buying power computation is how it is, like the way far out of the money but very wide iron condor, like because 20 delta to 10 delta is in fact a lot of strikes because the curve gets pretty flat out there. That winds up being not that much more buying power efficient than just selling like really close to the money strangles, which they don't ding you that much for. Well, and I just to kind of put it into practical matters, because sometimes we talk about this on the show. If you're trading in an IRA and you're kind of proving the point here, you can almost mimic margin account by buying something pretty far out, and that's where you're seeing it. It's almost the same buying power when you're just buying something. So we ask, is it risk definition, or are you trading in like a cash secured account where you have to mimic margin?
Exactly. Or you need to maintain buying risk, or right, or just if you're sort of new to trading options, or you're a smaller account and you're getting used to it, you might want to stick to defined risk trades, just so you know what's going to happen. Right, the undefined risk is right there. The name, it's kind of scary. So this is how our buying powers work out. And the real thing I want to do is contrast it with the next slide. So probably, John, we're going to want to like flip back and forth between the next one and this one a couple of times. To see how conditional value at risk sort of compares to it. When we look at the exact same set of trades, but look at what their conditional value at risk is. And again, this is conditional value at risk managed at 21 days. If you look at the iron condors and their expiration conditional value at risk, it's almost exactly the same as the buying power reduction, because you get about 5% full losers, unless you're working really far out of the money. You'll get 5% full losers unless you're trading super high pop. But managing at 21 days, we think is a nice way to sort of bring down our conditional value risk. It cuts these things down. But what we'll see here is that if we go to the next slide, you get a really big reduction, right? The conditional value risk for strangles is way less than their buying power reduction, right? The actual, right, because they're undefined risk, the brokerage and the regulators are having you stake more capital than you really are probable to lose, right? You very rarely actually lose that much. Whereas in the iron condors, even managed at 21 days, right, the conditional value risk is lower than the buying power reduction, but not by the same factor, right? The short 10 deltas, strangle is like the most extreme example, where it goes from like a multiple of 20 some down to 3.6, whereas like, right, your 40 to 30 delta, like kind of tight near the money iron condor, goes from like a 0.86 to a 0.7 or something, right?
It's really interesting that you're actually not risking that much. That first line with the strangles is pretty eye-opening.
Yeah, this is, I think, a lot of the time when we do these sort of looking at what buying power means is that strangles very rarely come out as their big losers. Right? The buying power computation is pretty conservative for them. The brokerages don't want to be stuck on the hook for you having sold some strangles you couldn't cover, so they put the buying power.
That's not their job, right? I mean, their job is to collect the dollar in commission, right? Make sure that everything clears. That your money's in your account, your customer service is there. If not the position itself, that's on you.
Exactly. And they don't want to be stuck with, oh, you got blown out in this position, now you can't cover it. Then that's not the position they want to be in. So the buying power reduction is a very conservative estimate for the undefined risk trades. Whereas the conditional risk is sort of a more apples to apples. If you have enough account, right? If you're worried about your account being blown up, right? If you're a smaller account and you can't actually have them that many positions before you're sort of in danger, then the buying power reduction is what your limiting factor is. If you're in a larger account, probably your limiting factor is not so much what your buying power is, as it is how much total risk you want to take on and where your opportunities are, right? How many underlyings actually have good volatility conditions? You can't want too many positions in any one underlying, those sort of things. And so there's sort of a transition phase between, Anton and I had this theory that Tuesdays were going to be a small account day, and I haven't done the best job of sticking to that. But the idea that got me here was the idea that in smaller accounts, you really are very buying power constrained, where in larger accounts, that stops being your limiting factor, and what starts being your limiting factor is sort of a more personal, what is this risk to me? And in that sense, I think conditional risk is a more applicable metric for, if your account is unlikely to be blown up by one bad strangle, then you don't really care about the fact that it's an undefined risk or what the BPR is for it. What you care is how many good strangles are there to sell, right? And in that kind of sense, your conditional risk is more relevant.
No, but I think you hit the nail on the head too. It's kind of like you have to, when you start with a small account, you need to be a little bit more defined risk, and your buying power is kind of where you hang your hat. But once you get into more portfolio looking at it or a larger account, your CVAR is where you're going to hang your hat, right?
Exactly. And that's the point of today. So sort of see how when buying power is your like primary limiting concern, you wind up needing to trade those defined risk trades because the buying power per credit on the strangles just is not as good, right? You have a much higher multiple. Whereas once you get sort of past that and that's not your limiting factor anymore, then you can start considering conditional risk. And then you see a lot more, right? There still is more risk in the strangles than there is in the iron condors. Like, undefined risk is more risky than defined risk, but it's not by the same order of magnitude, right? It's by, a doubling or so, not by the, factor of 5 or 10 that it was on the last slide.
And this is kind of off topic, kind of not, but when you're saying this, the strangles aren't as risky as, when you say undefined, but it's not undefined for life. Everything has a finite end. You're looking at 45 days. You're looking at trades with 45 days to expiration or wrapped around there. You're not saying I'm going to have unlimited risk in Tesla for life. You're just saying for the next 45 days.
Well, I mean, you're not even saying for 45 days, right? This is all with management of 21 days. This is saying
21 days, yes.
For the next 24 days, I'm gonna have it, right? And even then, right, your risk isn't fully whatever, right? Because even if your strike gets super broken, because it still has 21 days left on it, there's going to be this smoothing effect where the value of the option is not going to fully capture the full value of the underlying move.
Yeah, it's pretty interesting.
Right, 100 times it. That's our market measure today. It's just sort of looking at how these different trades compare, and then thinking about why we care about them separately, and why sometimes one is more important to us, and for some people we need to be more focused on one or the other.
Can I ask a platform question? And shame on me for asking this, and I should know the answer to this. I know this is CV. I know this conditional value at risk kind of position to position. Is there an overall account CVAR number?
We don't have it on the platform, but I'm told by Tom last week that I believe it will be done in the next week or two. Like, it's already in beta and it's being tested, so we should have a CVR number in the Tasty Trade platform in the coming week or two.
But that is position by position, right? That's the one where Julie and I were talking. Like, do we include the winners on 99 pop trades? We're like, no, don't include the winners on 99 pop trades. But yeah, that's coming very soon. But that's going to be position. For the whole portfolio, like, what is your worst? Given the way that the platform is So when I've done CVAR here, this is all historical. Like I've looked at of 30 Delta Strangles, what were all of their losers in the past 15 years, and then what's the worst 5% of those. The platform one is going to work the same way that the POP and IDM percentage and things like that all work currently on it, which is that it takes the implied volatility and runs a whole bunch of simulations, the Monte Carlo method. And so it's doing sort of a theoretical, what is your condition value risk, in the same way it does your theoretical POPs and your theoretical P50s and things like that. So that'll be interesting, but no, portfolio wide, it could do a portfolio wide condition value risk area. You could run all of your underlyings and then look at the worst 5% of all of your outcomes. But I don't know that that's coming as soon as the position by position one, which will be there very soon.
Okay. Good to know.
I don't know about that either.
Yeah. But in theory, the stuff is under the hood to do it. So once they've got the one in there, they can maybe do the rest of them.
But it's almost like analysis by paralysis, kind of, you can kind of take a holistic view of it and position by position instead of looking, like you said, your 98% pop ones. Do you even need to include those in there?
Right. I probably have one, no. But if you're carrying 36 98% pop trades and different underlyings, then yeah, those start to matter. One of them is going to be bad losers.
True.
Yeah. All right. Let's go takeaways. So for our undefined risk trades, the condition value risk was significantly less than the BPR. Managing at 21 DTE meant that it was still lower in the defined risk trades, but not by as much, right? When we went from BPR to condition value risk, the strangles like super dropped, whereas the iron condors, came down a bit, right? They didn't lose their full loss when they lost, or even 5% of the time. But they lost, much of it, 70, 80, 90% of their buying power could be lost on a bad loser. Whereas in the undefined risk trades, the bad losers managed 21 days pretty much never lost their full buying power reduction. I think it was like twice in the whole data set.
So the numbers worked out, you mean?
Yeah, right. It was like once in 2008 and once in 2020.
It sounds about right.
Yeah, those are the times where if you were short strangles, you did in fact get dinged for your entire buying power reduction, even managed 21 days. But otherwise, it just doesn't happen. Whereas, in larger accounts, you're often more interested in minimizing your tail risk, right? That's really what your control is, right? The regulators and the brokerage and their like little penny pinching, what's your buying power like? That's not that relevant to you anymore at some point. What matters is you don't want too much tail risk. You want to be collecting good credits. And that can make sort of the lower relative condition value risk in the undefined risk trades much more appealing, right? You want to trade those strangles because it's more capital efficient in that sense. But in smaller accounts where you're really constrained by your buying power, right? You want to put on enough trades to get your occurrences up to get sort of more reliable results. And the only way to do that is to do these things that have a much lower BPR. And that's going to come, from using narrower, closer to the money iron condors. Right, that's how you can manage to turn a meaningful profit, even if you have less initial capital. But you have to be aware that capital is more thoroughly at risk. Right, that you can lose if you've got 50% of your buying power deployed and it's all in defined risk trades. In 2 months, that could all be gone. If you have 50% of your buying power deployed in undefined risk, it's very, very unlikely, especially if it's in a diversified set of underlyings, that's all right. In 2 months, even if things go really badly against you, that's not going to all be gone, right? Just the buying power reduction was given as a much more conservative estimate.
That's such an interesting point you bring up, Jacob, a little bit subtle there. Yeah. When you think about it, people always go define risk trade. I know what I can lose. Well, there's a good chance that you will lose it. And when you have an undefined risk trade, and they're taking, a couple of $1,000s in buying power, there's really a good chance you're never going to lose that money because I don't want the brokerage firm. Nobody wants to be in charge of your trade. That's on you. So it really is kind of funny that you bring it up like that, it's very interesting and quite true at least from my own experience.
And I actually think that's the plight of the new traders. They all want to find risk, but it can actually all go away. And then you're left with nothing.
Mm-hmm. Yeah. Yep.
Right. When you define your risk, that risk becomes a much more thorough form of risk. Whereas the undefined risk has then the tail is really out there in the unlikely events, as opposed to on a defined risk trade, especially if it's narrower or closer to the money. That tail risk is right in your face. It can happen to you every day.
Yep. True.
And that's my last point here is that the flexibility involved in liquid option markets means that a small account, large account, right? These are sort of, I put them down as two categories, but of course it's a gradient. It's a spectrum between the two. And you can sort of adjust your strategies as you go on, right? You start off and you're only trading sort of tight defined risk trades. And then as your account grows and you become more comfortable, you sort of you start by widening out the wings, and you get to these like very wide iron condors that start behaving in a probabilistic sense much more like strangles do, right? If you're trading, 30 delta with a 5 delta wing, that's very similar to selling a 30 delta strangle, but your risk is defined. And you will find that your buying power reduction, if you make them really wide, will in fact get worse.
You can actually add money to the trade by putting a wing on.
Right, because then it looks, what's your maximum loss?
Yep.
But like that, if your long strike is so far out that in the like 20%, 10% BPR undefined risk BPR computation, your wing is out past that, then you will add buying power reduction. They will make it cost you more because you put this defined risk on it, because they just switch which category they're doing the computation for.
Yeah, you can actually add buying power. It's kind of crazy.
Yes. Right. And that's, I think, sort of as you're making your evolution as a trader, and you're going from all sort of narrow defined risk to wider defined risk to wider defined risk, at some point it's going to be, this defined risk is so wide, it's time to just stop buying the wings.
Correct.
Good job, Jacob.
Thank you, Tony.
Appreciate it. Little nuggets in there. We do appreciate it. We're going to take a good.
I understood it. So thank you, Jacob. I appreciate you going easy on me.
Yeah.
We're going to take a quick 90-second break. We'll come back. We won't go easy on Scott Sheridan next. Tasty Trade World Headquarters.